I think the tariff story, it's a convenient excuse. It may shine a spotlight, on gold, but I really don't believe that it is the tariffs. I don't think you're going to see a big slam on gold this time around, simply because the big buyer happens to also be the strongest hands. That's China. And China is not going to let gold, let's say, peaks out, pick the number, $3,000. China has too big of an appetite for gold to allow the price to drop to, say, $2,100, $2,200, $2,300. I don't see that in the cards at all.
While the gold space has been obsessed over the gold streaming from London to New York in reaction to President Donald J. Trump's tariff threats, even as it had little effect on price, the bigger story is that the People's Bank of China is quietly stockpiling gold at a frenetic rate. Direct gold exports from the UK to China, a proxy for PBoC purchases, remained impressively strong in November at 50 tons. As the Chinese central bank secretly bought approximately 600 tons of gold in 2024 with $50 billion, it's confident that the dollar price of gold is going up. BillHolter is a seasoned financial analyst known for his insights on global economic instability. With its insatiable appetite for gold, Holter believes China will prevent gold from falling, especially if it nears $3,000. As of February 3, 2025, spot gold reached an astonishing $2,818.58 per ounce, highlighting a significant shift in investor sentiment amid rising economic uncertainty. While reflecting on the current scenario, Holter doubts tariffs are the main driver of gold's rise, instead citing the U.S. seizure of $300 billion in Russian reserves in 2023 as a key turning point. Concurrently, Holter mentions rising gold and silver premiums, particularly in China. He attributes this to a shrinking physical supply, noting unusual flows as London delivers to New York, signaling a tightening market. Despite tariff discussions, Holter predicts February, with silver following in March. Since the day of the U.S. election, though, physical inventories in the exchange's depositories have swelled by 13 million ounces, around $38 billion of gold. J.P. Morgan issued delivery notices for 1.485 million ounces of gold to meet physical delivery for the February gold 100-ounce contract, with deliveries on February 3rd. That accounted for roughly half the total to be delivered, with Deutsche Bank AG, Morgan Stanley, and Goldman Sachs Group Incorporated making up the bulk of the rest. Now, we present the clips of BillHolter's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
First off, if you put gold on, gold as cargo, if you put it this week, it's not going to be here before the 1st. I think that the tariff story, it's a convenient excuse. It may shine a spotlight on gold, but I really don't believe that it is the tariffs. I mean, you could go back. Actually, I think you need to go back. What would it be about a year and a half ago, or not quite a year and a half ago, when the United States sequestered the 300 billion of Russian reserves. I think that's when you saw gold bottom. I think it was October, November of 23. Gold bottomed, and then from there it just it's been like a tractor in first gear. And I think you definitely have, and we know this because they've tracked it back through Switzerland. China has just been a methodical, voracious buyer, and metal from London, those are 400-ounce bars, and China likes kilo bars. So what happens is the metal goes from London to Switzerland, it gets recast and then shipped out to China. And I mean, China has just month after month, even though they went, 3, 4, 5 months without even reporting. So it was said that China was no longer buying. I don't know that either. I think, China has bought all along. As I said, I think the tariff explanation it's convenient. And I think really what's happening is the gold is finally running low. We went for years, probably 5, 6, 7 years, where the EFPs, the exchange for physicals, in both silver and gold in London, exploded. They're hard to see through, to see the actual settlement. as opposed to COMEX. If COMEX doesn't deliver, it's one way or the other. Either they deliver or they don't. The EFPs are behind the scenes, and you really can't get a paper trail as to whether they actually got settled or didn't get settled. And there's been a premium, as you know, we've seen there's been a premium in China as high as $3-4 in silver and $50-60 in gold. Now that premium started to emerge, and yes, it did widen when the tariff talks began, but there is premium now in London over New York. So it's kind of it kind of doesn't really smell right. What you would have in a true arbitrage, the buyer would buy at the lower cost zone, which is New York, and they'd be delivering into London. Whereas what it looks like now is London is delivering to New York. I think that's because of the February COMEX deliveries for gold. And I think you're going to see the same thing in March with silver. So, you know, silver is going to be right behind gold. The premium on London silver is over $1 now. I think there's only 2 months or 3 months where both gold and silver have the same month of active deliveries. You know, some months there's like no deliveries at all. They're throwaway months. The next month for gold is February, and the next big delivery month for silver, I believe, is March.
Precious metals expert BillHolter speculates that China may hold up to 35,000 metric tons of gold, surpassing all other central banks combined. He links the surge in central bank gold buying to the U.S. seizure of Russian reserves, arguing that nations prefer gold over treasuries to safeguard their assets from potential confiscation. China is also a major buyer as the world's largest producer of gold. Its Gold Accumulate program, established in 2010, allows citizens to buy gold in small increments, minimum 10 grams, with banks holding it 1-to-1. This program could significantly boost retail demand for gold. Since 2014, the U.S. Treasury market has been losing its share as a primary global reserve asset. Global central banks have sold approximately $400 billion worth of treasuries while purchasing $600 billion worth of gold. A growing gap between the supply of U.S. Treasury bonds and the demand from global central banks drives this trend. As the dominant player and consistent buyer, China effectively steers the gold market, reinforcing the decline of fiat currencies. Holter argues that China's massive reserves bolster confidence in the yuan, positioning it as a stronger alternative to the US dollar. Let's get back to the interview.
China being the biggest holder, and they are the biggest holder. I mean, I could have shown you 5, 6, 7 years ago that China had already amassed 25,000 metric tons versus the supposed 8,300 tons that the U.S. has. There's not been an audit done since the 1950s, and we can clearly see the paper trail of metal being delivered into China. And basically, for the most part, gold does not exit China. They are the ones who are going to be able to control the price. And you've got, call it, you know, pretty close to half the world in the BRICS. All these central banks have been buying now, going back to when the Russian reserves were stolen or sequestered. We don't call it stolen. Russia calls it stolen. And the rest of the world views it as stolen. And that's why central banks are buying gold as opposed to holding treasuries, because if the U.S. can do it to Russia, who on the planet could we not do it to? Or who would we not do it to? We would do it to anybody and everyone. I mean, if they've got, my guess is they probably have 35,000 metric tons. That makes them, you know, by multiples, the largest holder of gold and holds more gold than the rest of the central banks worldwide collectively. So what that does is, once that becomes known and widespread, what that does is it makes China basically the navigator of the gold price, because they are the biggest player. They're a continual buyer. It basically shows the world that the BRICS half of the world than
Bill.
U.S. treasuries or any
Bill.
other treasuries. It basically illustrates the fiat currencies are collapsing in value, and China being the largest holder by far of gold, it makes them, they are the captain of the ship as far as the price of gold is concerned, because they own so much of it and they consistently, month after month, accumulate gold. So unless China wants the price to drop, you're not going to see the price drop. And because they do own so much gold, I mean, that obviously makes the yuan, the Chinese currency, there's more confidence in it, because we know that, or the world knows that they're sitting on the largest stockpile of gold.
Gold continues to demonstrate consistent growth, driven by robust macroeconomic factors. The upward trend is evident across all time frames. Although short-term fluctuations cannot be ruled out, the precious metal can climb to the long-term target of $3,200 to $3,400 in 2025. If China continues its massive gold accumulation and fiat currencies weaken further, could we see a complete restructuring of the global financial system in favor of gold? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.